Okay, I think we can start. So, yeah, welcome everyone. I hope people were able to access the canvas and do the quiz. If you haven't done the first one, you can still like skip one, like if you were not able to. Um, but week two quiz is already out. You can check that on Canvas. It's due next Monday, 2 a.m. And yeah, it is about 30 minutes long. It won't take that long, but we are just giving more time so that if people need to solve on paper or something, they can do it. And other than that, any doubts on like previous sessions? Anyone? Mhm. So maybe I'll just do a quick recap also. But before that, I have some like announcement. So firstly, the next class would be on 24th, and we'll distribute hoodies in that. We'll check the names of people who are like enrolled in this class or have done any like 5 events before. So that's the one announcement. Second would be on the next following week, Wednesday, we'll have WorldCon's VP coming in person to give a session. So that would be like first ever actual trading company in here. So I'll create a poster for that soon, but like it's mainly for you all the people in this class. So try to show up. I know it's like a midterm week, but hopefully this would be something that's very helpful for you to connect to the industry. Okay, so recap. Let me actually quickly share the attendance form. So fill out that. I shared it in chat. Um, and then I'll go ahead and recap once you fill that out. So you can do it quickly. Let me stop sharing.
Of the definition. Because if the ring is commutative, which means A.
Mm, no longer accepting. Okay, wait 1 second. Let me. Hmm. It should be accepted. Hmm. 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 On my end, okay, I will try to. Um, okay, I'll try to modify that later, maybe. So don't worry about it now. I'll see it at the end so that at least we cover what we have. Can you still not access? Can someone check why it's the case?
Still no access.
Still no access. Okay. Um, question response. Oh yeah. Okay. Now it should be okay. Found out. So yeah. Uh, okay. Let me share back the screen to week two. Mm. Okay, so in week two, uh, there were mostly uh, talks about options, and we're gonna continue that this time also. So, firstly, we had this forward and future contracts, and we said that why do we actually need options? Because we don't want to be obligated to perform transaction at a specified date. Um, and then, so options are more flexible. These are the benefits. Then we have options as like two types, mainly put and call. The payoff of a put option is K minus ST plus. So basically, it's always um, a positive number. Um, and K is your strike price here. So opposite would be call option, ST minus K. S is your stock price. Um, that's your payoff. And then we had long versus short graphs. You might have faced that in so you will face that in quiz too. Uh, so try to uh, revise that. Then um, next was binomial model. So using these models, you can actually find out about the fair value of an option at time zero. Um, and that involves your up and down factors. So try that on your own, or you'll also see that in quiz. So that was a very good example that Megha shared. Um, about call option, and you can also like just program this using the code we have given you, and it will give you like the fair value of option, so you don't have to do it by hand. And that is available on the link um, shared during that session. It's also on YouTube, so you can see that link of Google Colab and try that on your own. So that was week two. Now let's go towards week three. Mm, any doubts in this, like week two content? So now, like, I just want to continue on options little more. And one more thing to add upon that is what is the terminology of in the money and out of the money? So in the money basically means that you are making profit out of that option currently. So if you think about the call option, which was K minus 60 plus, and uh, you are getting a positive value out of that formula, that means that you are in the money. So if you just exercise it now, you will get something out of it, right? Out of the money means currently it has no value, it's worthless. So it's a zero value. And then if you are right at the price, so your like strike price is basically same as the stock price, that's um where you are at ATM at the money. So that terminology would be used today a lot. So um going forward, you can just use the acronyms. Then, so why, like, how can we know that the options value are changing, right? So we saw the binomial models in the previous class, but it's obviously not just by binomial distribution, right? It can be continuously changing. It depends on several variables. And to monitor that, there are four or five major Greek variables that are used to assess the options market. And specifically, they help us to find out what's the risk in taking these options. So each each of these Greek variable I'm going to talk about is a result of an assumption which is not perfect, uh, given that underlying like stock or option. So these options are used a lot by traders to manage their portfolios. So our first one here is theta. So theta um, measures the decrease of options due to passage of time. So intuitively, you can think about this as close you are getting to the deadline of exercising the option, the value of option would decrease, right? Because you are getting in a very risky condition. You may or may not be able to find a profit out of that option. So theta is something that always decreases the value of an option. Now, how it will decrease is a matter of different other things we'll talk about, but it will always decrease. So you can see this graph here. The option value is decreasing um, in this 9 month period. So let's say you bought at the x equals 0, or like where 9 months is written currently, and then the price of option will keep on decreasing given there is no other change, right? So we are assuming that, okay, if just because of the time, what's the change in value of option? So for example, if you have like an option worth $5 on day 0 and your theta is 0.5, then it would be of $4.5 on day 1 if other factors remain same. So this 0.5 theta is what matters. But more the value of this theta, more the option is sensitive to time, right? So if you are decreasing at like a rate of zero point 0.9, that means uh, each day it's costing like like it's decreasing by $0.9, which is huge. So theta increases in magnitudes as options approach expiration. So you can see that over here, this slope here is increasing, right, with time. So basically that means your rate of decrease is increasing, and as soon as you get to expiration, the theta is actually maximum because there's no more time left, right? But does the theta actually increase in magnitude continuously? So here we see that like the option price is decreasing, but theta may or may not be, right? And why that would be a case is because the uh, the situation, if you are in the money, out of the money, or at the money, impacts the value of theta. So let's say you are currently out of the money, right? So you're somewhere in this left graph over here, this region. Um, this uh, says that, okay, your option does not value currently any money, and there is a lot of time left for it to expire. So you just like literally bought the option, it doesn't value anything. So with small amount of time, it won't vary much, right? So your theta would be very, very low and like mostly close to zero. Okay. But as soon as you are like getting closer to the actual stock price, so let's say you bought your option at um like $10 and your stock price is like 30 or something. So then at the price where like the stock is actually worth similar to the option price, you'll start seeing actual high rate of theta. So like theta is increasing from this time to this, right? Increasing in magnitude, because theta is always negative, right? Like theta suggests that there is a decrease in the value of option. So theta is always negative. But when we say is increasing, that means we are talking about the magnitude. So here we can see that like theta is increasing over time. And actually for this graph, the strike price was 50. So K is 50. And if you say that K is 50, then at that price, the theta would be of maximum magnitude. So why is that? Because at the money, your theta impacts a lot. So the time impacts a lot at what the value of option would be. Um, and which is why like at 50, you will see that, okay, everyone is trying to either sell that option or buy that option. So like you are right at the point where people are trying to exit this option or are trying to enter that option. So it's like uh, the area where theta would be maximum. And then again, once you're in the money, you're basically making profits, right? So now your theta won't vary much with time because you're already in profit. So now it's up to you on like how long to hold that option until your expiry. Okay. So theta is maximum, like even on theoretical basis, it would be maximum very close to this price of strike price, and it would be little ahead, not behind. So it won't be like 47 or something. It would be usually like 52, 53, something like that. So which is little more than your strike price. So one of the graph, like combining these two graphs that we talked about, the first one was theta with respect to time, and now this theta is a function of price. Now if we combine those two, you'll see that how like option value varies over time. So if you bought a option which is uh, at the money, so like you bought which was right at the money, so that time only you'll see that okay, it's like it should decrease very steeply. So now you can see this blue curve, it's decreasing very quickly. Red and green are relatively lower because they are uh, out of the money, so they don't actually value anything now. Deep OTM means like it's very, very far from getting to the profitable value. So that's like even lower. And eventually you will see that, okay, like option value would expire to zero, right? So everyone has to converge to zero over here, but after expiration. But you can see that how it would vary with time using theta. So theta is mostly used here uh, to assess how the value of option is changing with time. Okay, I'll just stop for a minute. Any doubts? Anyone? Okay, so that was our theta. Now, next is, okay, let me clear this. Next is delta. So, delta is our primary Greek variable that's like used in all the models, everything. So, delta measures the change in price of option due to change in the price of stock itself. So, just by an example, if you say that there is a delta of 0.5, that means for a $1 increase in stock price, options value will increase by zero point 0.5. So, multiplying 1 with zero point 0.5. So, delta is usually or like always between 0 and 1 for call options. So call options is where you are uh, seeing an increase in stock price will result in an increase in options value. So that's like a direct correlation, direct proportionality. And then for put option, it would be between -1 and 0. So the negative means that for an increase in stock price, the value of option would decrease. So uh, their delta of like -0.5 would mean that for a dollar increase in stock price, your option value decreased by zero point 0.5, right? So here you can see that there is a graph here. We can see strike price again is 50. So here that is. And the delta is varying with the asset price. So initially it was here 0. And as delta increases, or like delta actually increases with the asset price increasing, right? So the more it increases, the higher the delta. And one of the main like usage, uh, or not one of the main, but like one of the usage is that when you see a delta value, you can actually estimate that there is how much chance for you to get uh, the option as a profitable option eventually. So at the expiring, what's the chance of your option to be in the money, right? So 0.25 means there is a 25% chance. 0.5 means there is a much higher chance, like a 50% chance of the option being profitable at expiry, right? So you can think of it as like a distribution where like uh, it's a probability to show that, okay, this option would be uh, this much percentage. uh, this option is 0.5% or like 50% possible to be profitable eventually. Okay, see it down. Okay, I'll just do that later. So next up, the usage of delta. So primary usage is hedging, and what hedging means is in basic terms that you are trying to reduce risk by uh, adjusting your portfolio in some way. So here, let's say that we sold 10 call options that have a 20 delta. 20, or you can think of it as like zero point 0.2, but in like usually traders language, it's just called 20. So anyways, 10 call options have 20 delta means you have a net delta of 0.2 uh, into 10, which is 2, or you can just do 20 into 10, which is 200. So because you sold it, right, that would mean a negative sign. So you are on a minus 200 delta right now. And your task, or um, a trader's task, is to be delta neutral. So delta neutral means you don't want to predict the stock itself, right? You are not saying that okay, the stock will go down or up. You want to make profit without making that prediction. So how to do that is by being delta neutral. And what you can do is you just buy two futures contract. So futures contract is a direct contract, right? You are saying that, okay, it would increase, then I'll get the exact price. So future contracts have delta either +1 or -1, depending on what you bought for. And here, since we are buying the two futures contract, that would mean a +1 of delta. So 2 into +1, and then um, minus of 10 into zero point 0.2 would give you a net zero of delta, right? So what you have done is you have created like a portfolio of option with future contract, and you are delta neutral now. So whatever happens, you are at not a great risk. You will probably be profitable, and we'll see how you'll be. So let's see um, one example of like how this kind of questions are actually asked in like assessments. So there would be a lot of technical terms, but now hopefully you can like break it down. So let's see. An options premium is 1.5. Um, so that's like your initial cost of option. You can call it C. Um, it has a 40 delta. That means um, zero point 0.4 is the factor by which options value change given a dollar change in stock price. With the underlying future, this is basically stock price at 100. So now the question is saying, if the stock price moved from 100 to 102, what would be the options new premium be based on delta? Can anyone type in chat or speak up? What would be it? So join from mobile so that I can see the chat.
Recording in progress.
Okay. I'll just say quickly, like it's not a tough problem. It's just like you have to see how much is the delta. So 100 to 102 means like a $2 increase in the price. So how much would the option increase? So option would increase by 2 into the delta we have. So 2 multiplied by zero point 0.4, right? 40 delta. So that would mean 0.8 is the change in options price, and that would be increased, right? Because your future actually increased, uh, or the stock actually increased. So 1.5 plus zero point 0.8, that gives you 2.3. So your new options premium would be $2.3. Okay. Any doubts on that? Wait, let's see. No. Yeah. Okay. Cool. So yeah, that's correct. Um, so 2.3 would be the new price. And you can see that delta is actually very important, right? That's what matters. How would you value the stock option depending on the change in stock price, right? That's what we were primarily doing in our binomial model. We also learned about the time variation today, but usually delta is very important. So not just delta is important, we need to monitor how delta is changing over time. So for that, we have another Greek variable called gamma. So gamma is simply the rate of change between options delta. So you literally can differentiate it. So gamma indicates the amount the delta would change given um, a $1 move in the underlying security. So in the graph, you can see if you just differentiate this curve equation, you'll see that, okay, this is the point of highest slope, right? So um, that is the place where gamma would be highest, and it would decrease for the edges. So that edges are when you are like very out of the money or very into the money, right? So your gamma is also mostly maximum when you are at the money. So using these like delta and gamma, what option traders like to do is they want to become neutral with both with respect to both delta and gamma. So you can like probably try to find a question, or I'll like give it one in quiz on like how to be both delta and gamma neutral. But it is very similar to the idea that we did in the previous one, that was delta neutral. You just have one more equation to solve. That's it. So that's about gamma. Now, next is implied volatility. This one is not actually a Greek variable, but it would be helpful in another Greek variable that we'll learn. So implied volatility is like market's forecast of a likely movement in the stock price. So um, when you are applying like when you are understanding in terms of stock, you are saying that, okay, when investors see that a stock is decreasing over time, um, you generally have a higher volatility. Means it doesn't directly mean that your stock price would like increase or decrease. Volatility just means how much is your variance. So when your stock market is decreasing, it can vary a lot. It can like keep on decreasing a lot. It can like keep going up a lot. So generally, like uh, bearish markets means that volatility would be high. And this is governed by sigma. So sigma is our variable denoting implied volatility. And you can see that higher volatility would mean that options are valued higher. Why? Because options are generally meant to be bought or sold when like your market is so volatile that you make like huge profits, right? So uh, higher volatility would have options value higher. Okay. So why do we need to know it? Because next is our another variable Vega, which is uh, where you represent the rate of change between options value and its volatility. So how sensitive to the market volatility is your option, right? So Vega denotes that. For example, if an option within Vega of zero point 0.1 indicates uh, that if 10 cents is the change in your options uh, value would be like 1% change in your implied volatility, or like you can do reverse calculation. If you see that, okay, volatility changed by 1%, then how much would my options value will change? That would be 10 cents. So for $1, yeah, we are talking about with respect to $1. So zero point 0.1 into 1 is just 10 cents. So that's how Vega matters. And what is the effect of it? The main effect is that you can uh, see in this example. So let's say we have an option price of 7.5. The volatility was 25%. That was initial time. So this is like time zero. And your Vega is 0.12. So that's what you already know. Now, if your volatility changes to 30%, then your options price would increase because your volatility changed, and that would be given by 7.5, which was your initial price, plus the change in volatility, which is 5, into 0.12, which was your Vega. So that gives you 8.1. So just because of the volatility change, that's the change in options value. Okay. So we did first time, second was the stock price itself, and third was volatility. Anyone can think of any other variables that can be important? Mm. Okay, so I know these three are actually very intuitive. The one next is rho, which is rate of change in interest. So usually in like specifically binomial model, we do not have a change in rate of interest. We just consider that as like just 3%, 4%, whatever the bank has the rate of. But that can also change. And if that changes, again, your options value would change. And it can be a continuous function. So as you can see in the graph, your row here is changing with some curve. And if that changes, your options value would also. So uh, to measure that, we consider row, which is if your row is like 0.05, and you have the call option with price of 1.25, then if your interest rates are increased by 1%, so uh, your value of option would increase by 1 into row, which is uh, 0.05. That means 0.05. So what would be your final option value? You would have 1.25 plus 0.05. So That would be your value of option if the rate of interest changed itself. Now, everything we covered until this point is individual, right? So we thought about, okay, how would my option value change if the time changes, if the stock price changes, if the volatility changes, if the rate of interest changes. But while considering these, we are not considering other variable also changing, right? So every time we just uh, say that, okay, all else being equal, right? So no other conditions are changing. Each one are independently just changing by themselves. So how do I incorporate all these into a single system or model where I can use these variables to get a fair value of option, right? So earlier we used the binomial model to like just say that, okay, this is the probabilistic uh, expected value, and that is my value of option. But here we also have these variables that we can think of, and that can help us find out what's the fair value of option. So for that, we have finally a model which is famously called Black Scholes model. And the idea is that we are continuously revising the delta. So continuous revised delta hedging, and we're gonna incorporate all these Greek variables, but mostly the important part is delta because your stock price are changing. And there are some assumptions made even in this model, but it's a very robust first model that was ever built to like actually price the options. So um that's like a big name. If you even search on Google, you'll find so many articles on it. How did they came up with it? Um, and all of it basically came from like physics heat wave equations similar to like Brownian motions. All those equations helped to form this model for like finance or mostly options. So the assumptions made here, first one is that we are not paying any dividend during the option period of exercise. Second, it's like a European exercise model, so you cannot exercise the option anytime between till the expiry. You just have to like do it at the expiry. There is an American version also, but this is like fairly easier to understand, so we'll do that for now. Markets are efficient. So as we talked about earlier, efficient market hypothesis. So markets are efficient means we do have all the available information and we are like trying to build a model. So something you can like have a look on efficient market hypothesis again. And then there are no transaction costs. So like buying or selling options or all those transactions does not actually cost you anything. Fifth is that interest rates remain constant here. So for here, your row doesn't actually matter much. Interest rates would be constant and prices are log normally distributed. If you haven't heard of log normal distribution, here is one, the graph, which is how is it compared to a normal distribution. So normal distribution just has a single bell in the right center. Uh, but since your options value cannot be less than zero, um, you have you should follow a log normal distribution where you consider that, okay, like prices just cannot go below that zero price, and thus this is the more appropriate distribution used for prices here. So that's about assumptions and like the idea. But now let's see like what's the equation. So um it has two parts. The main equation is right here in the red and blue, which is the option value which we actually want. So we want to aim the C. This is the value of call option, and we can um, calculate it using this whole equation, which has a lot of variables. So we have to like break it down into several parts. So first, uh, we'll break down into two parts. The first part is the red one, which is um, pseudo probability, which is like an inflow. So how your value of option is changing just because of the stock price, right? So S here is the current stock price. And then the next term is the time value, right? So here you see a term of time, you see uh, the strike price and another log normal distribution. So that's where your options value is decreasing uh, because of the variation in these two. Okay, so that's like one split. Now think about what uh, uh, other like splits can happen. We'll talk about each of these, but firstly, like what are these ND1 and ND2? So uh, these are log normal distribution we talked about, and basically you are giving log normal distribution the parameter D1 and D2, and D1 and D2 are given by uh, this formula. So you don't actually need to worry about like what those mean for now. But basically those are helpful in calculating your delta, right? So you can see here in the table, the delta is given by ND1, and for port it would be in like negative of it. So that's the formula. For all others also, you can see the formula. You don't need to remember these. These are like always referred or already in the calculators. But to like actually derive these gamma, vega, theta, and rho functions, you can use these formulas where mostly you are just using the normal or log normal distribution. So for this, just this last image, the V is the value of option price. But like for other images, we are just using C as the call option price. So delta V by delta S, that is the change in value of option as stock changes is given by delta. Gamma is the differential of that. Then Vega is how option price is changing with respect to sigma, which is your implied volatility. Then theta is how is it changing with respect to time. So that has its own formula. And then the rho, which is how is it changing with respect to the rate of interest. So all these formulas can now be combined and used into this one single equation, which comes from the Brownian motion, delta hedging. And we don't actually want to like go into proof, or I would rather go into like what's the use of this. So let's like actually see in practice how this is used. So there is one example. um so the example here is, let's say we have a Microsoft call option, um and we would like to know what's the fair value of it. Now please note that this is the tick or the Microsoft code, right? So the stock is called MSFT. October is the expiration time, so that's the expiry. And 70 is the strike price, right? So this is your strike price, which it will expire at. So K, which you usually see, is your 70 here. So in short, it is written, but that's what actually it means. And then call option in the year 2000. So Microsoft closed on August at this price. Based on it, we are trying to find what's the fair price of the call option, um, which is still 58 days in to be expired. And again, as we want to use Black Scholes, we are assuming no dividends. And so what things we would actually need to like uh, find out the option value besides these information is the interest rate and stock volatility, right? Because we already have K, we have S, which is your 70.75. So this is your S. We have KS 70. We have the time of expiry, 58 days. And um, log normal distribution will just be given by your D1, D2, which needs the interest rate and volatility. So if you go back, uh, we go back to the mm, mm, yeah, mm. Yeah, so in this one we can see that the n of D1 and D2 would require us uh, the stock volatility, that is sigma, and the rate of interest R, right? So you can see sigma here and your rate of interest. So we would need that so that we can calculate the call option price. So what we can do is we can use some data which is already available, and that is here we are using like from a Wall Street Journal, we found out that the T-bill rate is 6.1%. And we found out that the standard deviation of Microsoft is 0.56. So those can be like used for interest rate and the volatility respectively, based on what's like previously seen. Okay. Um, I will touch upon this again in some time, but that's what we are using now. So what if we used it? So let's like plug in values. So we had this formula, right? For D1 and D2. So let's like first calculate D1 and D2. So stock price was 70.75, K is 70. Rate of interest, as we just saw, 6.1%. Then sigma is the standard deviation, so 0.567 we saw in the report. That square by 2 into t. All this calculation gives you a D1. And then you can similarly calculate D2 from using D1. So that gives you this. So these two are the values now we can plug into the original formula in the next slide. But also we need to calculate the normality, right? So the values of D1 and D2 are plugged in into the normal distribution and you'll get these. So finally, you have basically n of D1 and n of D2, and we can use those to find out our call option. Any doubts up till this point in the Black Scholes? There's still more to like calculate, but any doubts? Okay, so um, now we can plug that in, and that would give n of d1, which we calculated, into stock price minus this whole expression that gives the call option to be $7.04. So that gives a fair value. That's amazing. It was actually very, not very close, but fairly close to that value in that during that time. So what could have possibly gone wrong in our calculation, right? Like what's the variation that we are not considering? So it's not just something that we miscalculated. We are not considering the volatility as we should. So if you remember, I told that we should be using implied volatility, right? So implied volatility versus a historical volatility is different. And that's what actually made our calculation wrong. So implied volatility is when you are forecasting or like you're um, making a prediction on how much the market is volatile in future. Okay, so this is your futures market change. Okay, but what we actually end up using in this calculation was the historical data, right? We used some Wall Street Journal's data on how volatile was the market until 23rd August, which was like the day when you bought options. So you should not consider the uh, volatility before it, but should use something after or like in the future. So um, that's one thing that we should be changing. Now, how we can do that? So instead of solving for the call option itself, like the C that we are solving for, assume that the market determined C is actually correct. So currently, if you just open Microsoft on 23rd August, you will see there is some price of the call option, right? So assume that it is true and then solve for the volatility, because volatility cannot be actually known through anything, right? You cannot predict how volatile the market would be. Um, but in general, when you see that, okay, this is the call options price, first you can reverse solve the volatility that can satisfy this equation, right? So you have the C, you just want this sigma variable um, to be calculated. So calculate that first and then like do the reverse engineering. So once you calculate the sigma using the price is given. So this is like a short formula for doing that. You have call and put option available, the current actual call and put option price available with you, and then the strike price and the time period rate of interest. So then you will calculate the sigma. So if you calculate that, you will see that, okay, the implied volatility was actually 36%, which is much less than what we actually used. We use 57, right? So this can indicate like how much the volatility can impact. And what people usually do is like they keep on doing this calculation over and over again so that they improve the model, right? So you use this value, then you say that, okay, like what if my volatility would be a 5% range, within 10% range, within like between these two values, and then you try to calculate the value of option according to you, right? So that's how like your fair value would be different than other people, because the volatility that you are considering might be different than others. Okay, so that was all about how you can like use this Black Scholes model for getting the right value of options, right? So now this is not just about probability, it's more that you are doing the delta hedging, right? So you are trying to reduce your risk also, and also take in account into all other factors except the interest rate, right? So we considered um, the variation in stock price, we considered volatility, we considered gamma, which is like rate of change of delta, and we also considered like other variables, but not the interest rate. So that's something we can further improve, right? Um, the volatility that we used is actually not a constant, right? So that is one thing that you can think about. And second is the interest rate. So if your model, the Black Scholes model, is not working properly, that means the volatility is not constant. It's probably changing very much during the time of your option, or your rate of interest can also change a lot. So usually that's not the case. So the row which we consider is not something that changes a lot, but volatility does. So an improvement upon the Black-Scholes model is the Heston model, which does actually consider the change in volatility, right? So it's a stochastic volatility that's being used in Heston model, and that is where you can consider more like a generic market. But Black Scholes has been like a set trademark for doing all the quantitative finance option pricing. And so it was very important to cover this in the lecture. Now, this is like a formal definition if you like to describe how Black-Scholes model was made. So it's like a continuous time model of stock prices built on Brownian motion. So that's coming from physics side, which I talked about. And then that includes a constant parameter volatility sigma, describing the risk of stock. So as you can see, we said a constant parameter, right? But it can actually vary, um, which is improved in the Heston model. And mostly all the Black-Scholes is derived from differential equation, right? We saw the delta, gamma, and Vega, rho, all the equations, those were differential model. Now, one thing I would like to share is quickly a visualizer for this. So let's go to one of the links that was already in the slide. So I will share the slide also later, but uh, there is a very good visualizer for all these variables and the stock option prices. So let me share quickly. Okay, so this is like a calculator made just by using a Python program. You can look into that also. So what we have to do is, as we said, we just have to input two things: the risk-free rate, which is your rate of interest. So here currently it is 3%, and your volatility, right? So we are using 0.3, which is 30%. Um, these two are main things that you actually input as your estimate. Even your risk-free rate can come from banks, so that's not something that you have to worry much about. Volatility is something that you are doing as an input by yourself. Asset price is what current stock price actually it is right now. Strike price, you will see that in the while buying the option, and then time to expiry is what you set. So these, like all other things, are known when you are trying to calculate the option price. So when you have all these, you can just let me like change a variable here and see how does that look like. So oh, okay, it doesn't allow 0.4. Okay, so if I click enter, what it would do is the values would change and it would calculate what's the call price, what's the put price, what is the delta, gamma, theta, vega, and rho for these values. So the option price, you can see it's increasing with uh, the price asset price increasing. The delta, so these are graphs similar to what I took, just the values might be little different. So gamma is maximum where the delta's slope is maximum. Obviously delta and option price would be increasing with uh, increase in asset price. And then theta is something which is highest in magnitude at the uh, strike price, right? So that is close to 50. So you can see here the strike price I set to 50. If I set this to, let's say, 60, oh, 60, then you'll see that the theta curve would move just a little ahead of 60. So uh, theta does matter with um, how much is your strike price. And Vega again is maximum at close to the strike price because you are at the money, and now you are um, in a very um, in a very market which is very well volatile. So Those are the things. Rho again, we don't need to worry much about, but rho here is how the rate of interest is changing. So that was about all these. This link, let me share this in chat if you want to play with it for a minute. Um, so here is that. And you can also see like how they actually did the calculation. So let me actually go to this link. So there's nothing much to do. There's just one Python file you can make. I'm not gonna go over like how to like type it all out, but basically the same formula that I gave in the class would work here. So prices are calculated based on if else cases where C is your call option, P is your put option. The price is uh, K into exponential of minus RT into the normal distribution. So this is your normal distribution value. And all these are the individual Greek variables graph functions. So those are also very straightforward. So you can try that at home. Okay, so that was all about options. Any doubts at till this point? I would jump to next topic because in the next session we will have WorldCon like taking one of our sessions, so we might have to cover a little in the this week or the next week before we can do that session. But I would really encourage you all to like actually practice the WorldCon's um, competition because not just because they are coming, but it's like very helpful to like apply all these um, learnings in that portal. It's like fairly easy if you just become comfortable once. You would know how to actually build the alphas, which are um, the trading strategies that you are currently thinking of, you might have thought about before. So try that. I'll just share something that I found very helpful. Um, is that all the operators. So okay, let me share screen again. So if you go on this learn tab, whenever you sign in, you can find data and operators, and then you'll find detailed operator descriptions. All these uh, are very helpful. So like skewness, kurtosis, rank, all these are like automatically done for you. Like you don't have to implement from scratch. You can just use these functions to like calculate how much is the kurtosis, how much is the weighted delay, how much is the rank of a matrix, all those. So it's very helpful to like go over these kind of examples and see how these can be used in your alpha. Your alpha may be actually even very small. Like I have tried some of these and they are like just 3 4 lines of code that made the alphas perform very well. And you can also see the competitions rank. So the competition won't last till like the whole spring quarter. So try to like participate before that so that you can get the leaderboard points also. Uh, but anyways, I'll continue to some small part of the next session, which is on moving averages. So this is like more on a trading strategy that is helpful in calculating or predicting stock prices. Moving averages. So let me share this link to you all. Um, Let me know if it's accessible to everyone. You can type in chat. It is accessible. Anyone? Okay, thank you. So, what is moving averages? Um, Simply when you have stock prices, right? You are calculating the average closing price of a stock for last n days. Okay. So let's say you start calculation on January 1 and assume that stock prices are like increasing $1 per day. Okay. And your initial price on January 1 was 100. So uh, for the moving average, what we'll do is we'll calculate the average for 5 days. So sum of um, um, January 1 to January 5 prices would be divided by 5, you'll get 102. If you do it for January 2 to 6, that would be 103 and so on, right? So uh, what I'm doing here is I'm calculating for 5 days, including this one, but excluding the sixth day, right? Like when you say 5 days, you are excluding the 105th day. So uh, these um, moving or like averages which are moving over the time uh, is used in our trading strategy. Okay, so I hope you got a sense of what's like a moving average. If you can think of it also in a graph, like let's say you have these as a stock price, you are basically calculating moving averages, which are this. Then you calculate over this period of time, then over this period of time, and so on. So those are individual values, and now you can like plot those also. So if I calculate that average, I'll create a point of that, and then I like have a similar graph. But it is a averaged graph of 5 days. So how does that help? So what we can use from this to make profit is that whenever your short-term moving average uh, crosses the long-term moving average, so it's called a golden cross, you will have a buy signal, right? So basically, you can see that your current stock price is increasing at a very high rate than it is usually in, right? So that means the stock is likely performing very well and you want to buy it. So that's the buy signal. Um, Otherwise, if it is the short-term average is much lower than your long-term average, then it's a death cross. Means it's a selling signal that it's a point where you should exit the stock, right? So let's like imagine this in a simple setting. Um, so I'll just run these ones. If you want to run this, you might have to create a copy. So you can just go on file, save a copy in Drive, and then you can run it on your own. This specific file cannot be run directly by this link. Um, so this is just a library I'm installing so that I can do the calculations easily. Um, and you can like sign up on this website to get an API key. So this is where I'm getting the data from. You can also get the data from it. And once you do it, you can, okay, I have to create the environment file. Okay. Um, Maybe, yeah, we do have enough time. Let me try to do it. So yeah, just like a 1 minute break so that I can upload the environment file. Mm. Okay, then back. So, okay, so what I did was I just clicked on files and upload button, and then I uploaded a file with just the API key. So the API key you'll get from this website when you sign up. But now, so what I'll do is just get data of Microsoft um, from this range of date. So from 2010 January to 31st December 2019, it's about 10 years of data. And what you can see here is how are the prices changing over time. Now, what I will do is to implement a trading strategy, I'll set short and long look backs. So I would see my short moving average is of 50 days and my long moving average is of 120 days. Okay. So whenever this average crosses this one, I have a buy signal. If it's less than, then it's a sell signal. But how much, right? Like we don't want to do it every time it just like crosses a little or more, right? So for that, you can set how big of a change you would consider as a buy signal and how short of a change you will consider as a sell signal. So um, these are the rolling averages. Um, one short look back. Yeah, okay. And so here I'm actually calculating the moving averages using the rolling function, and then dot mean would give the average. So first you sum all those, then you take the mean, and you can do that for both short and long. And then I'm doing uh, a signal where if my short moving average is greater than long moving average, then I have a buy signal, right? So that is where I create buy signals. Similarly, you can do sell signals, right? And these are the positions which would be helpful in plotting. So um, now we have to just plot this. So let's see like how the plot looks like. So you can see these blue triangles and orange triangles. These are the buy and sell signals. So this is where you can see the stock original stock price is in the green. Uh, and you can see that it's orange and blue lines are much smoother. Sorry. How do you pick those look backs? Oh yeah, so I mean you can try to adjust if you want to see just like 5 days, 10 days. So that's your hypothesis. Now, how would you do it? I would suggest not changing that much, but rather seeing that, okay, if I want to do just by doing this, how much of a change I would consider a buy or sell signal, right? So firstly, I would do like a very small thing so that I get like a very bunch of buy and trading like signals. And then I can increase my threshold. Increasing the threshold would decreasing your would decrease your amount of signals generated, but those would be significant ones, right? So just like one or two sell or buy signals would mean that, okay, these are very strong point where this stock should be sold or bought or bought. Yeah. So those are moving averages. How did I like create this? I'll talk about little more here. So here, what I'm doing is I'm plotting all the um, locations where the the short look back was more like from the short look back, all the locations where this adjacent close price was more. So um, let me actually, I think we can try to continue this later. I think some people have class at 120 or 130. So let's like continue this next time. We also have exponential averages, um, which is much more interesting than this one. So that's about like averages, but you can go over this file and see if that's helpful. Any doubts in like until this point? Anyone? I would likely create a form so that I know how many people are coming for the WorldCon session, so that I can manage capacity or like broadcast it as much as we need. Otherwise, it would just be for our class. So please fill out that when I sent it out. I'll probably send it on Piazza and on your emails. Good luck on the quiz and let us know if you still face problem in taking the quiz. Goodbye.